If you're getting into real estate, you might wonder, how do I build business credit for my real estate business? It's a really great question, but if you're going to build business credit, you have to understand what relationship that plays to real estate. And do you even need business credit for real estate? Let's go. Hey there, my name is Mike Fritz. I'm the founder of Titanium Capital Investments and Power Up Real Estate. My greatest passion on this channel is helping investors and business owners just like you create financial freedom through investing and business entrepreneurship. This video is brought to you by our free multifamily masterclass that teaches you how to invest in multifamily real estate without using any of your own money. I want to give you that free 60-minute training free today. Just go into the description, click that link, and you get your free training so you can understand this powerful world of real estate without using any of your own money. So what does business credit have to do with real estate? Business credit has to do with real estate because we want to separate what you do in real estate from your personal assets. Separating your credit and separating what you do in business from your personal life protects you. One of the reasons we put all of our real estate in LLCs is if a tenant slips and falls on our property and sues us, they sue that business, and it protects us owners of my personal home and my cars and my personal life. It protects them from that lawsuit. So we put them each property into its own LLC to encapsulate so those lawsuits don't come back on us. Business credit kind of works the same way. If you were to have to file bankruptcy in your business for some reason, and God forbid that ever happen, you don't want that to hit your personal life. So we want to build up your business credit and build it up over here so it protects you. And again, understanding business credit is the credit score your business has that doesn't really attach to your personal life or your personal credit score. Now, business credit's a little different when it comes to commercial real estate because when you're buying a 2 to 4 unit building, like for example, in the multifamily space, they're going to go after your personal credit for that unless you're buying that in an LLC. So that's why we want to buy it in an LLC and buy it in that property. But if the LLC doesn't have enough credit to support that purchase, they're going to want you to come in and guarantee that loan. And we're going to talk about what that means in a minute. But when it comes to commercial, which in multifamily is 5 units and above, commercial real estate's a little bit different. Commercial real estate has 6 different assets. It has multifamily, it has industrial, it has office, retail, and mobile home parks. 3 of those assets serve the end user, 3 of them serve the business community. The 3 that serve the business community, office, retail, industrial, that is more serving business owners. The 3 that serve the end user, mobile home parks, multifamily, and storage units, those all 3 serve the customer. So when you come into real estate, into commercial real estate, you got a bunch of different assets. But how does business credit apply to these? Well, it's interesting. When a bank looks at a commercial asset like this, and this is why I love commercial real estate much better than residential, when a bank looks at that, they look at the quality of the product. They look at it like a business. So they are asking, does that business make money, and can that business support the money that I'm going to give it for this loan? The power of that is not as much falls on you as the borrower. And this is really powerful in commercial real estate. Now, it doesn't mean that none of it does, but much less of it does because you have the asset to protect you against the bank coming back on you for that money if something were to happen. The asset itself can be sold. The asset itself makes money, so the bank feels more comfortable with that specific asset. So when you're building your business credit, you can actually take out that loan in your business name if your business has if your business has the backing and if your business has the trust of the market, meaning does it have enough credit to actually take out the loan? When I first started in real estate, I didn't have business credit, so I took it under my personal name. Now, when I say personal name, I still put it in an LLC to protect us, but I personally guaranteed those loans. So when you think about personally guaranteeing a loan, I want you to think about lending in 2 different categories when you come into real estate, and commercial real estate in particular. I want you to think about agency debt and conventional debt. Agency debt is Fannie and Freddie, Fannie Mae, Freddie Mac. That's government debt. That's the government loaning you money. That's always going to be a more powerful loan with better interest rates. And then you have the local banks, local credit unions that give you money for your real estate deals. Now, how does business credit play into this? You're going to see in just a minute. But there's something called a PG, or a personal guarantee, or you may hear the word recourse or non-recourse. What that means is recourse means that if you don't pay, they can come after you personally for that money. Non-recourse means they can't. They can't come after you personally for that money. So agency debt is non-recourse debt, meaning they don't come after you, which that's why everybody loves agency debt. But when you come into agency debt, you have to understand agency debt has a lot more boxes to check before they give you that money. The very first one is the health of the property. They usually won't loan you money if the property isn't above 90% occupancy in the commercial space. And so they're going to make sure that asset is already stabilized. But it's also going to require that your net worth is equal to how much money they give you. So if you're going to take a loan out for $1 million, they want to make sure you have $1 million net worth. They won't loan you more than your net worth. What a lot of people do, if they don't have that net worth, they'll bring in a partner who does have the net worth. And so you can still get agency debt without having the credit. But again, agency debt is non-recourse. Then you go to like credit unions in the local banks. Now those are recourse, so they can come back on you. You do have to personally guarantee those, but you don't have to have a net worth requirement. And a lot of times those banks will loan on properties that aren't as stabilized. They don't have to have 90% occupancy as long as the numbers still work. And so you've got two different sides of debt. So when you think about building your business credit in relationship to real estate, it's really great if you can come over on this agency side because it doesn't require as much net worth and you don't have to personally guarantee those loans. So you can build your business credit without having to guarantee anything. So what I like to do, bring in partners that have that net worth so you can build your business credit without having to personally guarantee. Now you can also build your business credit with a personal guarantee, but it's a little bit harder to do that because they want a personal guarantee against your assets. Unless all of the real estate you own, and you own a lot of it, is in its own entity, then they can loan against that and they can use that as collateral on the conventional when you're just talking about a local bank, a credit union, something like that. So when you're going to take out money and you're building your business credit for real estate, you want to, again, use that business name in order to get that money. But sometimes getting that money is a little hard when you're just starting off. So the best way to build business credit with real estate is bring in people that are more powerful, have more lending power than you do, but make sure you're on the loan because it'll build your business credit, but you have somebody else there to help you get that deal done. And when you go to these banks, one of the things they're going to ask is what is the DSCR? DSCR, the debt service coverage ratio, DSCR. They're going to want to make sure that is 1.25 times the net operating income. So the net operating income needs to be 1.25 times the actual mortgage payment. So what that means is if your mortgage payment is $1,000 a month, they want to make sure that the net income, net operating income is income minus expenses, then your NOI, net operating income. They want to make sure that number is 1.25 times the mortgage and interest payment. If it is, they feel more comfortable with that. So they want to make sure that you're making more than the mortgage payment at a rate of about 1.25 times. So that's a good thing to know when you're going to these banks and building your business credit so you don't bring them a property that is never going to fit their requirement. Because again, part of getting money from banks and building your business credit is looking like a professional. But also remember, this video is brought to you by our free multifamily masterclass. I want to give you a free 60-minute training today to help you see how to get into multifamily real estate without using any of your own money. So go into the description, click that link, snag your free training, and make sure you watch all of it and see how powerful this industry really is. And also make sure I have tons of videos on this channel on real estate and business and building your business credit. So make sure you hang around and watch as many videos as you need to make sure that you're successful. I'll see you in the next video.